Good morning, everyone. This is Jeff Cooper with the Daily Market Report, coming to you on, Tuesday morning before the open. In yesterday's video and in our Daily Market Report, I stated that the S&P was set to rally. I said if the S&P can rally through and hold its 20-hourly moving average, it is in a position to challenge a declining trend line for mid-October. This would coincide with offsetting Friday's down gap. So here you see an hourly S&P and how yesterday's early rally was rejected by gap fill here and from this trend line. The S&P opened above its 20-hourly MA, but was rejected from the hourly trend line as it reversed from gap fill. An opening range breakdown followed by a failure to hold Monday's up gap saw another free fall. Let's take a look at the 10-minute and I'll show you what I'm talking about. So here's the first hour high, and we had an opening range breakdown right here below the first 30 minutes range. That's how I define an opening range break out or an opening range breakdown. I bracket the first 30 minutes range. That break, that orb, opening range break, was followed by a move below the gap, which is a bearish event. So you can see that it pulled back into the gap, traced out a bear flag, and then once it moved back below this low and the gap with authority, we got a waterfall decline. Importantly, the S&P in yesterday's rally also failed to clear our key 2728 pivot. This is 360 degrees below the all-time record high. Then it failed below our 2676 pivot, and another free fall played out as we mentioned. A scary late 60-point S&P plunge hit the tape before out of the blue, what looked like a kumbaya stick save showed up on the runoff. Obviously, the large funds just had to be buyers in the last 20 minutes as the market was going on the cliff, right? Obviously, large funds, most of which have fiscal year ends on October 31st and are trapped long, just had to own them in the last 20 minutes before October 31st. It just shows you what a manipulated, manufactured market this has become. Be that as it may, despite the short-term shenanigans, Mr. Market has an innate way of adhering to natural progression in time and price. And those of you who have been watching these videos and who have been reading me for some time, or subscribers, know that we've been warning of a red October for 2 months. So time and price do work in the markets, despite the algos and the programs. The bottom line is, if the S&P rallies today, there is a ton of resistance at 2670-ish. That entails a back test of this trend line and a move down from this high and this secondary high. So right in here, X marks the spot right at the 50 period on the 10-minute basis. Now, we've mentioned that a decline to 2600 S&P would satisfy a measured move. Let's go to the dailies and you'll see what I'm talking about. This January to February decline was 340 S&P points, and a similar 340-point decline from this 2940 high ties to 2600. Yesterday's late reversal came from 2600, and that arguably satisfied a possible measured move of the January-February drop. At the same time, there's another near measured move on the table. The drop from 2740 on October 3rd right here down to 2710 on October 11th is 230 points. The drop from the second leg down on this October 17th peak of 2817 to yesterday's low is 213 points, very close to the 230 points of this leg. So there are two possible measured moves, near measured moves on the table. At the same time, a parallel trend line has been tested. This ties a trend line or an upper rail from this high, the January high, to this high, and from the February low right down to here. However, the important point to make is that a trend line from the low of the year in February to the secondary low in April here was broken, and we have a close below it yesterday. So arguably the S&P is an important support. However, the index also closed, as I said, below this trend line, the February-March trend line. At the same time, there is a third new low on the S&P versus higher closes on the McClellan index. Theoretically, this has the makings of a low, but if not, the next 2 days are where the rubber meets the road, and if the market breaks 2600, the S&P breaks 2600, we could panic further. We are at support, but in bear markets, support is made to be broken, just as in bull markets, resistance is made to be broken. One of the reasons October is infamous for panicky declines is that it is the 7th month from the natural beginning of the year, the March spring equinox. W.D. Gann stated that the 7th period from the beginning of anything is the most fatal. When there is a major high in late August or September, as there was in the indices this year, then 7 weeks from that high ties to October, mid-October to late October, and sometimes sees a waterfall. This was the case in 1987 and 1929, and so far this year many big name stocks such as Amazon and Nvidia have crashed, along with a broad array of smaller cap stocks. So far though, the S&P and DJIA are down substantially, but they have not crashed per se. As I have flagged since early September, the stock market has been unfolding similarly to that of the same period in 29 and 87. Monday's market is similar in time to those progressions when sharp multi-week declines developed into crashes. In all 3 years, 29, 87, and 2018, the indices did peak around September. In all 3 years, the market saw a precipitous decline, a sharp rally, which we had here, a slide below the previous low here, and a short-lived rip that suggested the bottom is in. That certainly was the impression on the open Monday. If this analogy holds, the stock market should turn down with a vengeance over the next 5 to 7 days. If the market isn't sliding by Wednesday's close, the analogy will be broken, and the odds are that we have seen a low of some degree, and that will usher in some backing and filling, I think, and a rally that would start around the election, probably lasting 7 weeks into year end. That's it for now. With that, I'll let you go. Good luck trading today. Appreciate your time. Thanks for listening.